Good afternoon. My name is Alexandre Deslongchamps, and I'm a press officer for the Banque of Canada. I'll be moderating this press conference. Governor Poloz will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so please use the wireless microphone, which my colleague will bring to you if you raise your hand. We'll do one question and a quick follow-up to ensure everyone gets a chance, and then we'll see how much time we have for a second round. The governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. Governor? We'll go to Greg.
Greg Quinn, Bloomberg News. C.D. Howe Institute last week said that the Bank of Canada Act should be amended so as to facilitate the publication of rate discussions, including dissenting opinions. What's your view on that suggestion?
Well, I welcome an open dialogue around this question, Greg, but the fact is that what they may refer to as state-of-the-art or, best practice quite legitimately varies from country to country. In some countries, the governance around a central bank is highly geographic in nature or constituency in nature. Ours isn't like that. And so the idea of having if you like, being transparent, which I think is a good thing, and in many ways we've enhanced our transparency in recent years. Being transparent is a good thing, but personalizing it, which is what that proposal amounts to, I think is not necessary or necessarily helpful in our context. We prefer to work as a team that allows our diversity around our table to be one of skill sets as opposed to accountabilities. And with that kind of skill set, you obviously stress test all the views that we present in ways that go way out beyond the normal discourse in order to provide the most robust analysis that we can. And so I happen to think that providing all of those details would inhibit that kind of free exchange, and so I'll leave it at that. But it's an interesting area to continue to discuss it.
Yep.
You express serial disappointment in the global economy, but on the upside, there's been a long phase in fits and starts of strength in the housing market. Why isn't there serial excitement on your radar on the risks in housing?
Well, if we take the outcome in the housing market, to date we really have not stretched the relationship between housing building and our demographic estimates. So at no point have we gotten into the concern that we're building far too many dwellings in Canada, which would be a sign true overbuilding would be one of the key symptoms of a speculative trend. So we really have a case where we have continued price pressures and the edging higher of these risks, primarily in three major centers, obviously Toronto, Vancouver, and Calgary, and the rest of the country appears to be very well in line with all the fundamentals that we can put our finger on. And so in that context, I don't get serially excited to put out your premise, but it continues to occupy us and bear watching. And we're still satisfied that as the recovery proceeds, as our forecast lays out, that the numbers that we use to measure that imbalances issue will continue to evolve constructively. But it'll be a very gradual thing.
So we'll go to Dawn on this side.
Hi, Don Kern, Wall Street Journal. Relating to the theme of household imbalances, are there any areas in household lending that you're concerned about outside of residential construction? I'm thinking specifically of auto loans and other forms of consumer lending.
Well, we see some of the same vigor in the car market. So not just in Canada, but in the U.S. Okay, so we see very strong auto sector. which, as we know, is fueled in part by low interest rates. What we need to make sure is that through the course of this, that underwriting remains solid, and that those who are making those loans are doing a good job of it. And I think the main reason why it doesn't attract nearly as much attention, but it will and does in our financial stability review, financial system review, which is in December the 10th, I think. The reason it attracts less attention than housing is it's so much smaller than housing in terms of how a disruption might affect the financial sector. That's the kind of bar that we lay out. But from a macro standpoint, you have to ask, well, how will that behave if in the longer term? Is there a natural ending to it? And it looks to me like we're still working off pent-up demand that arose during the crisis and the recession. And just like with housing, you'd expect to see, as the fundamentals improve, those things come closer together. So, but again, you're right, it's something we're watching closely. It's more of a symptom of underlying strength that we have to keep our eye on.
Hi, Dave Parkinson at the Globe and Mail. Mr. Poloz, you've talked a few times in the past couple of weeks about how we're seeing a bit of a difference between when we look at the traditional output gap versus when we look at the labor gap, and that because of some of the conditions that you've talked about, we're actually maybe the output gap might look smaller in traditional measures, but when we look at the labor gap, we're seeing more of a lag over there. Right. I'm wondering, in terms of what we should be looking at and what we should expect the bank to focus on when measuring when we are closing the output gap in sort of broader terms, if we should be focusing more on labor measures rather than paying so much attention on the traditional, this is how much we've got on the production output gap. Right. And I guess if so, as an extension from that, actually let's go with that one. I'll ask the follow-up.
Right. So it's most important to remember that there is no single measure and never was. When you say the output gap, there are lots of methodologies that one could bring to that, and we do, to try and estimate how much it is. And over history, usually what you do is use each of those versions and see which one explains inflation the best. And that's a hard job, because inflation, as you know, can be influenced by a lot of temporary factors and so on. So all that to say that that's why we express these things as ranges. It's not just to blow a bit of fog or smoke into the discussion, but to admit that we don't know which of those estimates truly is the thing that matters to the underlying inflation momentum in the economy. But what we did in the box in the Monetary Policy Report was explain that for certain recessions, the non-typical ones, in the typical recession, the the output gap and the labor market gap they look the same. There's no extra information from either one. But when there's structural damage to the economy, then they diverge. So a longer cycle, like the one we're living through, and as we discussed, the exit of firms in the export sector are a symptom of that damage. So when that happens, the labor market gap becomes more your ultimate measure of how much capacity there is in the economy, because what you believe is that the capacity that has been destroyed can be rebuilt in another form on the other side of this recession. And as that happens, then capacity measured by output is actually rising and pulling the kids out of the basement. And so you get a convergence of them again with a longer lag than we normally get in a typical cycle. That's why we call attention to it. So my suggestion is that we continue to look at all those things, but of course we can't ignore the labor market measures at a time when we know they're likely to tell us more about the story I just told.
Sorry, just as a quick follow-up then, we know that the bank has developed a labor market index, a more broad measure than what we would look at in normal circumstances.
Yes.
It's not something you're publishing on a regular basis, though. Is it, in terms of wanting to be more transparent on this particular issue, is that something the bank is considering publishing?
Sure. Well, we first published what I'll call the LMI, which is a composite indicator based on a variety of underlying labor market data. We first published it in our Bank of Canada review, but last spring, with a fulsome discussion of how it's constructed. So it's not actually news to us, and we have been using it internally, and in the monetary policy report, the last two MPRs have shown it. And so I expect that it's becoming kind of a pretty good indicator. I mean, it's kind of a new thing, say, close to a year ago or 10 months ago. It's become a pretty good balancer of the various things that we're looking at. So you'll see it on a regular basis, and I expect that we'll find a place for it in that web part of the web page where you land, and there are various measures of potential or capacity, because it does summarize, and it's got great inputs in it. So it's one way at least, but I want to caution you that it won't be some sort of knife edge. Again, there will be a range of measures that we'll keep watching, and we have to judge which is telling us the best thing at the time.
Go to Salinara.
Solarina with Reuters. I guess the market sort of interpreted the tenor of your speech as more dovish, and I was wondering if that would be a fair assessment, or maybe a better way of asking is, do you see, risk asymmetrically, as in, more downside risk than upside risk?
Well, as expressed in the monetary policy report, we said there that the risks around our projection for inflation are balanced. It would be highly unusual for a forecaster to put out a forecast that was unbalanced. But importantly, that balance of risks, when seen through the policymaker's lens, would say, well, if there were the realization of an upside risk, that actually would be good news given where we are. And that, however, if we had realized a downside risk, that would be a more significant event, since interest rates are already very low, and we've done everything that we think we are capable of doing. There are other tools in the kit, but we're still confident that the thing is gathering momentum, as it should. So in that sense, the risks are unbalanced from a policy perspective, even though they look symmetric as a forecaster. The downside risk, it would be a much harder challenge for policymakers anywhere, not just here in Canada. So all that by way of saying, if you pick that up, as I said at the end of my remarks, it's that policymakers are understandably preoccupied with those concerns. And if they're wrong and things turn out to be stronger, that would be just fine.
Just a quick follow-up. You're saying you want to pull back a little bit from forward guidance and to look to the data for more of that direction. But data's been pretty volatile lately. Just wondering, is there any danger that markets will become more volatile, around the expectations of whatever the data may be?
Well, I think that would be exactly the point, that the natural volatility in markets comes from the underlying data. And so it's not up to the monetary policymaker to cut off that channel of adjustment in the natural marketplace, unless we are in a case where we're close to the zero lower bound, or if we have some other stress issues in the marketplace, in which case we might like to provide forward guidance to kind of reduce that kind of uncertainty if we're able. So that's the kind of the field of play, if you like. And so in my sense, saying like we did back in September that we expressed that we were neutral at that stage, and that meant that the timing and direction of the next change in interest rates depended on the data. Well, in my mind, that's not forward guidance at all. That's just ultra neutrality, and therefore it's appropriate to not then be somehow nuancing that or or trying to tweak it. Rather, let the data flow through the market and let markets grind out appropriate pricing. And I think it is healthier for us. If we go back 6 or 8 months, we were all kind of wondering, why is volatility staying so low? And, we got some volatility this past few months. It's a breath of fresh air in the sense of it brings a more normal kind of play into the marketplace. That's, I think, a healthy thing, and it's where we're headed. The more we get there, the more satisfied we'll be that the world is back on track to a normal kind of cycle.
David Friend, the Canadian Press. Last week, you mentioned the potential impact of low oil prices on GDP in 2015. I was wondering, in your opinion, if you could give an idea of what sort of impact persistently cheap oil prices could have on Canada's finances.
On Canada's finances, well, I'm not an expert on the fiscal situation, if that's I think, what you mean. So that's the job for the Finance Department and the Minister to provide an update as time prevails. But in this instance, what I expressed last week was our first cut on that for the Monetary Policy Report. We don't, in the policy report, forecast oil prices. What we do is we pick the recent level and we use it as a working assumption that it stays there. And then what we do is, in our minds, we test upside and downside around that so we understand how much of an impact it would have on our decision and whether we should be balancing the risks differently or not. And as we expressed there's a lot of upside and downside elements to bring to that oil price scenario. So we picked $85, and that's what we ran with in the forecast that we provided. And so that shows that by 2015, we're about a quarter point less than we otherwise would be. In our actual outlook in the MPR, our outlook didn't change that much, and the reason was because we had a little more exports in the second quarter than we had expected. So our starting point was a little bit higher when we did that analysis, and they were kind of roughly offsetting in terms of the profile for GDP. So all things said then, a quarter point is significant, but it doesn't derail that story of gradual convergence to potential. Not so far.
So we'll go to Greg here on the right.
Greg Bonnell, BNN. Of course, forward guidance is on the shelf, even despite not having any language about the neutral stance. Most economists saw the last statement as pretty neutral, and they assume you're going to be on the sidelines with interest rates for at least a year or more. When I look at your scenario today of 2 years to use up excess capacity, continued policy stimulus after that, should economists be pushing that forecast out? Have you on the sidelines for an interest rate change more than a year, maybe 2 years plus?
Well, so the paper that I published in September, or I guess it was 1st of October, went into this uncertainty problem in considerable detail and I hope rigor. And the idea is to convey that, in fact, there's no right answer to the question you just gave. So what there is a field of judgment, and that judgment is colored as the data unfold. So it's precisely why we think that forward guidance is not appropriate in this context. There's so much data every single day. They never go in a straight line. They're always up or down. They disappoint you one week that you think, oh, it's on track, another week. So we've laid out in full transparency all the issues that go in there and what that leads us to, a balanced forecast for inflation, which is our target. So that means that as far as we can tell, in a couple of years, we will be there sustainably. That's given the data that we have today. So the next conclusion really is up to the market to understand and, to, as I said, grind out as new data are laid out for us.
A quick follow-up. Since you took the job about a year and a half ago, you've been talking about the handoff from consumers to exports to business investment. How frustrated are you that the export thing really hasn't taken off? Because it hasn't as you wished it had of 18 months ago.
You're right. It has not happened, certainly as our framework suggested. It's been, as I said, serial disappointment. that serial disappointment has two legs. One is that the world has not performed as strongly as we expected, and that includes the U.S. And secondly, that even given that global performance, Canada's exports have underperformed what you would predict. So it was that latter question that we investigated more fully in this cycle and went into the 2,000 product categories. Those are within the 16 underperforming sectors that we identified back in my Saskatoon speech, if you like. That we put a paper out at that time. So there were 16 export categories that had been underperforming and we thought would continue to underperform. In there we found 2,000, there are 2,000 sectors, and of those, over 500 of them have declined a lot over the last, well, almost 15 years. So that tells you that there's something very structural happening. And that, when a structural change happens like that, a model, a regression, which tries to capture average behavior of all non-energy exports within it, simply can't cope with that kind of underlying change. So it overpredicts how much exporting actually happens. So over time, we keep adjusting our view based on that. Now we know roughly $30 billion never coming back. So that's very good insight. And so you use words like frustrated and so on. It's been more of a question mark, like why? You know, if you can't understand why, then you're really at sea as an economist. The model just doesn't quite capture it, and you talk to companies, and they'll tell you anecdotally, well, we're no longer doing this, or we're no longer doing that. And so this has been a very insightful exercise, and in the end now, I think we do have a full understanding of that. What has to happen now is that that bucket gets refilled in ways that we can't actually predict. We know certain sectors that are starting to grow, connected to the U.S. investment recovery. That would be bucket number one. But I think the most important thing is that historically, in these kinds of situations, we've begun to create new companies. And we have been creating new companies, but net, the population of companies seems not to have begun to rise yet. So a true self-sustaining recovery will have that characteristic, growth in the population of companies. And many of them will be exporting companies, and they will be the ones that fill that bucket back up again through time. I think that just requires more patience than I thought when we first sat down this job, as you say, close to 18 months ago. And it's basically now being fed by a deeper understanding, a richer understanding of what the underlying forces are.
So while we're getting over, so we'll take two more.
Candy Chen with Omni News. My question would be regarding the potential of having a Chinese yuan trading hub in Toronto or Vancouver, given that Prime Minister is visiting China this week, and also the two provinces has already spoken out regarding that.
So I'm not in a position to comment on the specifics. However, from base zero, I think it's a very positive possibility that knowing exporters as I do and how many of them are growing their business with Chinese buyers, I know that it's a significant cost to their business to have to go a round trip through US dollars. And so that's taking that extra, when you're in a business, a manufacturing business, you could be in a very low profit margin business. It could be well under 10%, often 5-6%. So if you can bring another percentage point back into the equation by having a straight route through RMB and Canadian dollars, that 1% is real money. So I think it's good for trade, it's good for business, so I'm very hopeful. We've been very supportive of the idea since it was first floated.
So last one would go to Tyler.
Hi, Tyler Sutton with the Public Sector Digest. We heard about the impact this recession has had on the labor market, youth unemployment and underemployment. Just curious as to your assessment about the long-term impacts of that trend with less experience coming out of school and gaps in resumes, that kind of thing.
Yes, I'm very cognizant of that. It's why we're bringing to bear this more diverse view of the labor market indicators to capture exactly that kind of thing. And it's why we say, for instance, the unemployment rate as it is today overstates the amount of improvement that we've actually had, because in the background, there are discouraged worker effects, and of course, worker effects such as the youth who may not even be answering the phone when the survey takes place. So we estimate around 200,000 of those. And the problem, of course, is the longer this takes, then the more likely it is that a brand new graduate is more attractive to an employer. And the folks that have been taking this thing hard and have not been able to engage in the workforce are scarred by it, and that makes it harder for them to engage with a good match where they're most productive. So we know that the labor market does not deliver its fulsome outcomes with a high efficiency, the high productivity matching until it's actually running pretty hot. When it's running cold like it is, it doesn't. So we have to be patient for that. And when I bump into youths, they ask me, what am I supposed to do in this situation? I say, look, having something unpaid on your CV is very worth it, because that's the one thing you can do to counteract this scarring effect. Get some real life experience, even though you're discouraged, even if it's for free. If your parents are letting you live in the basement, you might as well go out and do something for free to put the experience on your CV. But anyway, our belief is that over time, as the growth happens, there's sort of a natural draw for those kids to get those new jobs. The vast majority of those jobs that new recruits get are in new companies, young companies. And we're just beginning, I think, to have the right environment to get that. So we have to be patient.
Thank you.
Thank you very much.